Alright, hope everyone's doing well. So I'm doing this video outside, so hopefully the outside noise isn't that loud. So I wanted to just spend some time discussing always in. One of the things I do a lot is I go back to random days and try to focus in on really swing trading. And for most people, I mean, that's always in. That's as Al talked about. It's, buying the above this bar, buying the close over here, getting out below here, maybe selling, outside down, but it's really not that great. But I'll start with this day, kind of give a few points. So always in swing trading is, you've heard always in from Al Brooks, and that is if you had to be in the market long or short, the always in direction is the one you would pick. So bar one, prime example. If you had to do anything, you're buying above bar one. However, the issue with it is tight channel. First reversal is probably minor, and the bulls really need to break above the moving average. If you think about it like this, the trader that right here, this high, there's a 20% chance this is the low of the day. Sorry, I had a phone call and I kind of forgot where I was going at, but so think about it this way. If traders buy above here, 20% chance it's the low of the day. Traders selling here, stop up here, has an 80% chance plus that this is the low of the day. So, probability, sellers above, and this is minor. But anyways, always in long. If you aggressive, you can take it. Aggressive bulls buy. Some traders will buy knowing that this will trigger. But this video, I'm going to do my best not to kind of get into all that. Now, I'll finish what I was saying. Traders know that this bar will trigger, so a lot of traders will buy the close, betting that we'll at least get to there. Some traders will say, okay, I know we're going to close this gap above this bar right here. However, we may go 2 points above, so they'll sell 2 points higher. But this video is all always in. So anybody buying here knows it's minor. If it's minor, the always in direction is really short. This is the major high, therefore traders are going to get out below this bar. Some will sell below here. The reason, one problem with days like today is this is a trading range all through here, really the whole day. Same with over here. Problem with trading range is that it's never clear. You get 2 consecutive big bull bars, immediate reversal. You get a bear bar closing on its low that's a surprise, strong enough for a second leg down, and you get weak follow through on this bar. You go outside down, you make a new low, then you get a stop entry buy. However, the buy doesn't trigger, and it's following 3 consecutive bear bars, so you go further down. But anyways, it's always in short on this bar. Sellers above, however, the bar didn't trigger. Probably another surprise bar, however, you have to be open to a parabolic wedge. 3 pushes, 1, 2, 3. So, as strong as this bar was, I would not sell the close because of the big tail. But it is always in short. Bulls get out. And again, when you're trading always in, you're kind of ideally, you hold until it doesn't make sense to hold anymore. So in other words, if I was, as I said before, you'd buy, you get out of longs below this bar. Maybe you go short below here. Maybe you get out of longs above the bar, but it never triggered. And you're short here. You get out of longs above this bar, and then you get dojis. A lot of traders they'll just buy back their shorts down here, knowing it's going to go up here. But ideally, if you're trading always in, maybe you get out 4 or 5 ticks above this bar, or 1 tick above this bar. Now, again, I don't know how big the range is here. These bars this bar alone is 3 points. So, it varies. 3 ticks, 4 to 5 ticks above a bar. If it's a bear bar, it's kind of an average. But anyways, it's always in long, probably on this bar. Consecutive sell climaxes. Expect a few legs up, so always in long. No reason to get out. Really not a great reason to get out here either. Probably strong enough surprise for second leg. Possibly another surprise and a second leg. We just kind of channel up, so no reason to get out right here. If you did, you got to get long, get above bull bars. Really no reason to get out over here. So it's still always in long. It pretty much stays always in for the rest of the day. Exhaustion most likely, but strong enough for a second leg. We got the second leg. Bulls get out, aggressive bear sell. and probably strong enough that it's a surprise when we have to go sideways, but it's also a tight enough channel and a new high of the day. Tight enough channel will probably just form a trading range and go sideways. And I'll just start with this day over here. And if you have a question, just post in the comments and refer to the day. So I'm in Central Time. So if you can kind of, state the time zone that you're doing it in, preferably Central Time or Alice Time Pacific, if you can. Just state the day and the time zone in the bar, the time of really the time. So you want to talk about this bar right here, just 12:05 Central Time, February 22nd. So anyways, next day, gap down, but probably trading range. So not really a great short. You're shorting low in the range. 20% chance this is not the low of the day. 80% chance we'll go above it. A reasonable buy above bar 1, stop below. Always in long above bar 1. Doji, tail. I'd get out of shorts below that bar. You don't have to, but it's a double top, and it's reasonable to take profits there. Probably going to go sideways, and that's exactly why. So now clearly always in short. Strong enough surprise for at least odds favor second leg down. Big bar. A lot of traders, if you did sell the close, then theoretically bulls get out above the bar. Some traders will hold, and you can see what happened right there. A lot of traders they got out of break even. The bar was big risk. Bulls get out above this bar. Bears get out above. Aggressive bulls can buy, but not really a great buy. Possible 3 pushes down, 1, 2, 3, and a breakout pullback, so it's an okay buy, but why the big tail? Decent entry bar, always in long. Probably going a little bit higher, but deep pullback. Do you get out of shorts? Kind of tricky. If you get out of shorts below there, your stop's pretty close, so this could just be a pullback. So, I think a lot of traders would get out below here. It's reasonable to get out of shorts there, but it's not all that great. And doji, so you may rally, and new low of the day. So again, not a great buy signal bar, as I said, and a lot of traders would get out because of it. They'd be quick to get out. So, trying to form a bottom. Any bear that got out, that went short, gets out above this bar, the bulls buy. Strong entry bar, trying to bottom, probably going to get up for a few legs, may test the high of the day. So okay to be long. 3 consecutive bull bars, probably a little bit more up. So tight channel, probably the first reversal down will fail, but you can get out here. It's trading range. If you get out, I wouldn't sell, but I might get out and wait to look to buy a second entry. So really not great yet. And if you did get out, maybe you buy above here, but maybe you didn't. It's still not that great. May try to form a gap, but I don't think we're going to form a small pullback trend, so no rush in really even being long right there. So, getting a lot of bear bars, 3 pushes up. I think a lot of always in bulls. Some always in bulls will get out here and look to buy lower. A lot will get out below this bar, double top, and 3 pushes up. Getting a lot of consecutive bear bars. At some point we're going to get a lower high. We have a lower high here, so this bar may fail, which it did, so it went outside down. So a little bit of a surprise. Still not always in short. May just test the open of the day right here. And, sideways, kind of a mess. At this point, it's usually better just to wait for a breakout, wait for something clear. Not clear, nothing's clear yet. Can you buy here? You can, but hard. Stop placement's difficult. Risk reward's not that great. And then that's why. So big bear bar, probably surprise, probably at least a second leg down, but it's also a wedge 1, 2, 3, so you can sell. It's always in short, stop up here, but the one risk you run is 50-50 chance in general. If you get a bar like this, we will, or better yet, like bar 2, that this could be the low of the afternoon. Okay, so doji, minimum requirement for the bears was achieved, so probably at least a little more down. And there's our second leg, so you got to be open. We'll make another reversal, but it is always in short. And starting to go sideways, formed a second entry short. If I was still short, I'd get out above that bar. The bears had several bars to do something, and they're failing, and we're in a trading range. Trading ranges get easily disappointed, and that's exactly what I meant, why I'd get out above that bar. So that's pretty much it. And you can see on the, 2 legs up, strong bear bar, but pretty late in the day. If you sell it, you get out above a bear bar or above, a few ticks above. So you can see how this bar only went 2 or maybe 2 ticks above and then failed. So I'll do one more day real quick, then I fortunately have to go. But again, I just practice always in and just kind of how would I trade it. So big bar, I don't want to buy above. We're far above the moving average, and I don't think most days pull back. We're above average. The moving average is far below, therefore probably going to pull back. But if I do anything, I'd be long. So hypothetically, if I was long, maybe would I get out? I probably would get out below these bars. I think we're going to a new low today, and that's my point. So trading range, 3 consecutive bear bars, probably always in short, but maybe a second leg down. Strong enough breakout for a second leg down to the moving average, so okay sell. Doji 3, probably going at least a little more sideways to down, or collapsing. We may test the close. This is why it's important, even though it doesn't look great, just to sell, get in, because the odds are traders are selling because they know there's going to be a second leg, and they know that we're going to get down to here. Maybe we get down to somewhere down here. So it is strong enough for a second leg, and that's why they're selling. And even right here, the bulls aren't willing to buy. It's too strong. They know the odds favor a second leg, so why buy here when you'll get a second leg? It's kind of like saying, okay, why would I risk? If I'm buying, I'm risking an endless pullback. And if I know the odds favor a second leg down, why would I risk an endless pullback when I know it's going to have to go sideways for a few bars? So I might as well wait to buy and see it go sideways, then buy. If too many traders do that, and bears do the opposite, they sell aggressively, knowing that it'll have to go sideways, we may collapse. Always in short, smart traders may take profits over here, but again, profits, we may pull back to here. If you are short, better to have a stop somewhere up here. I'd get out above a bull bar, depending on how it looked. Still going sideways to down, most likely. Small doji, you can get out and sell again, but you don't have to. And that's what I'm saying about a possible deep pullback. I'd get out of longs probably above that bar. I'd get out of shorts above that bar. I wouldn't go long. And, and theoretically, if you get a second or short, maybe you sell here, or, maybe here, but bottom of a trading range, probably buyers down here. So probably going to have to go sideways for a little bit. So, and you can see what's happening right here. You're getting gaps. So it never clearly became always in long. So, the problem with if you get out, you have to be quick to get back in. So one thing I want to reiterate here is, if you're short and you get out of longs, it's a bad buy. And the reality is, if it's a bad buy, it's a bad sell. So for some people, if you really break it down, it's not a great place to take profits. However, for the fact that you sold here and getting out over here, you made something, maybe you do want to take profits and take a break, but you have to look to get short again. And that's the problem when it's so easy to get trapped out of these moves, and before you know it, you just get a big sell-off. But probably a surprise in a couple pushes down, maybe 1, 2, maybe 3. A lot of bull bars, but still no reason to buy. So this push down is the third, and it looks stronger than over here. This could be exhaustion. You have a low 1 and a low 2. You have a double top. So, in theory, if you're out of shorts, you got to look to get short again. Odds favor probably 50-50 chance you get a small second leg down, 60% chance you go above here. So best to look to take profits. Smart traders will just start buying back shorts. Other traders will wait for a bull bar, and there's your bull bar. So bears are disappointed. They'll get out above here. Some bears will sell up here and get out break even. But if you're trading always in, you get out above here. Aggressive bulls may buy. So good statement for the bulls, possibly the low of the day. We may go back up to here. Odds favor at least a small second leg. Okay, very strong. We're breaking above the moving average. Bulls, the bears hope for a double top measure move down, but only 40% chance, and we're really not even getting good setup. So clearly, and by the way, always in. If you don't buy here, maybe you buy the third or fourth close. No reason to get out. Maybe you get out here, 3 pushes up, 1, 2, 3, and look for a small 2-legged pullback. That's fine. But again, probably just going to go sideways, so it's really not all that great. And this is why bulls are buying, by the way. It's the same thing over here. Traders know even if we go sideways, theoretically the stop's up here, so even if we go all the way up here, we'll come back. So the bull's buying over here, they know that it stops down here. Even if we go all the way down here, we'll have to go sideways. That's why they're buying in here. And then you can see what happened. So we just kind of melted away, and strong breakout. So probably a strong enough breakout for at least a small surprise second leg up. But, you know, again, just like over here, we could get a small second leg and turn down. There's your disappointment. Second leg, boom. So maybe a strong enough surprise for a small second leg again. Down to here, this is probably exhaustion. We'll probably close this gap. So not really a great buy the close. You know, a lot of bulls are waiting to take profits. And when they do, if they've been long, they get this gift, they're quickly going to take profits. It's also the open of the day. It's the same thing here. If you're short and you're holding through all this holding, and then you get this, you're going to take profits. Getting late in the day, but forming a tight trading range. So the bear, you know, what happened over here? Okay, you know, if you're a bull, I'll give you two scenarios. Let's take this one. If you're a bull and you took your profit, you're going to wait, ideally 10 bars, 2 legs to buy again. You know, and you're going to give the bears, you want to give the bears a chance to see what they can do. Kind of like how the bears down here wanted to give the bulls a chance to see what they can do. So when you see this right here, you know, bears sell off, sideways, sell off, sideways. They try to break out again, sideways, outside up. You know, are you impressed by the bears, the resolve of the bears and how strong they are? Are you saying, gee, this is kind of disappointing, it's pretty weak? You're saying it's weak. Therefore, bulls will start buying again. Over here, if you took your profit, do you really want to sell after this? No, because this could turn out to be this. On a smaller time frame, you got this up here somewhere. You know, think about these tails. Went down, rallied, went down, rallied. So we're trying to channel. The bulls are trying to bottom, then they gave up. So strong breakout, and that's the end of the day. So, you know, overall for this day, you'd probably go sideways to the moving average, always in short, but again, probably going to pull back to the moving average. I'd get out of shorts above that bar. It's 3 pushes down, wedge, or at my target, also at these highs. And, you know, or, you know, maybe we'll break below and form a larger wedge and a failed breakout below. Bear breakout follow through, probably always in short. But you got to be careful. The odds you may just get a small second leg, and then we may test back up here. And that's why I said bear breakout always in short. You may get a second. You probably will get a second leg. So traders will sell, hoping for this, but prepared for, you know, something small, like leg 1, pull back leg 2. But then they got that, and, you know, again, collapse down. Probably have to go sideways for many bars, so no big rush to get out. That's why a lot of traders don't get out here, because they don't want to miss that. At some point, consecutive sell climax is probably not going much lower. You may go to the low of the day, but, you know, at some point, the odds greatly increase that we're going to get up to here. At this point, we're going to go up to here before we go way down here. So a lot of traders take profits. New low of the day, no reason for the bulls to get out, or for the bears to get out. You know, if you manage to stay short, I would certainly get out above here. Aggressive bulls will buy. But if they do, they may need a wide stop, you know, down here. You may rally, you may go up and fall below and then turn right back up again. So it could be a trap. And, you know, so this is kind of the problem you have with this. You know, I want to point something out real quick. This is kind of the issue you have. So a lot of people, and again, when we're talking about always in, I don't want to advocate this, because, you know, this is how difficult it can be. If you're buying above this bar, you get out below the bar. You know, it does not matter if you know it's probably going to bottom and you know it's probably going to fail, get out. Because too many times you may buy here and say, okay, and do just what I did. So it's reasonable. You buy above this bar, you say, okay, here's my stop. I'll put it a measured move down from this high to this low, measured move. Look how close it came to your stop. So imagine buying here, buying more here, buying more above bull bar and getting stopped out here. You know, it's It's a lot of money to lose, and it's usually it's not a, you know, one thing some traders will do is they'll buy here, and if they don't, well, actually, I'm kind of wrong about this. I want to point something out. What do you notice right here? This never triggered. So this is an example of the importance of, you know, preferably buying above the bar and not buying the close, because this happens often enough. Same thing here. You buy above this bar, but it never triggered. So that kind of, it's a statement by the bear. So strong enough for a little bit more down. You know, a lot of traders will buy calls down here because you'll probably get a significant rally, probably close this gap. So if you're aware of what's going on, you buy here, 3 consecutive bear bars. No reason to get out for a while. Starting to go sideways, you know, get out somewhere up here. 50-50 chance go. You know, you'll probably have a deep pullback, then a new high, then a new high. My voice is getting a little tired, and I'm about to go in a second. But you know, if you get out here, this is probably a yeah, actually it is. I was gonna say, on a 60-minute chart, look where we are. So here's 12:15, here's 12:30. So here's the close of a bar, and then here's another close. So pretty strong rally for an hour and a half. So this is probably some sort of signal bar. So when we go below it, the odds are we're going to have to go above it and trigger it. That'll be the last thing I'll show you. Then I'll have to go in. You can see then we rallied sideways. But if I go to the 4th and I look for 1355, I'll show you what I'm talking about. I don't know why it does this. So March 4th, 1355. There you go. So, you know, that's kind of what I was talking about. Where we were was, you know, it was an expanding triangle. Kind of 1, 2, 3, and then 1, you know, maybe 1, 2, 3, doesn't matter. So here's where we were. Here's the 13, the 1 o'clock bar. So that sell was right at this close. So think about that. What are the odds you're gonna go above the bar? Probably 80% plus. So that makes it kind of a bad sort. But anyways, there's no need to look at other time frames. Better to just look at a 5-minute chart, or just look at one. But eventually you start to see more and more stuff like that. All right, comment if you have any questions. Thank you.